Good morning, good afternoon. So this video will be on market structure. And before we begin, you have to understand this is an advanced price action technique. So this is probably the most difficult and complex idea that most smart money traders, this is where they fumble, this is where they miss their bearing. And before you understand the concept of market structure, as smart money traders do view, how smart money traders should view the market, I want you to drop all of your preconceived notion on price action. Everything you think you know on price, I need you to drop it. Come with fresh mind. Except you're following this our mentorship, then you can continue from the previously gotten knowledge. But apart from that, I need you to come with full fresh mind. And to understand market structure, you must understand the idea of liquidity and imbalances. This is why the episode 5 of this mentorship was on liquidity and imbalance. This market structure, this video on market structure should have been episode 6, but I had to make that video on honesty. But I guess I wasn't as honest enough as I wanted to be. But that's by the way. So, market structure. What is market structure? Market structure in its basic form is understanding with the information being provided by the algorithm. What's likely is the market trying to tell you? What is the message being passed across with the candlesticks? And before you go into the chart looking for a market structure, you must first understand your bias. You must first understand where price is likely to draw to, where price is likely to draw next to. That is the basic of everything we are doing as smart money traders. We are trying to anticipate where price is likely to go to. You can be wrong and you can also be right. But you being wrong, that is the human in you. So you should not take that as an indication of the algorithm being faulty or being bad, that maybe a lot of people are already understanding how it works, so they will change the algorithm. It doesn't work that way, and it won't work that way, because the whole basic of this the whole basis of this algorithm is to counter human behavior, and humans are flawed beings. So back to market structure. So when you understand the door on liquidity, when you've identified your draw on liquidity, using this concepts, this idea I'm about to communicate, using the market structures idea, it will help negate or confirm your bias. So if your bias is in line with the algorithm, you understanding the idea of market structure, it will help you confirm that's your bias. And if your bias is wrong, it will help you negate your bias. And let's dive right into it. Let's use yesterday's price action being Monday's trading. So we'll start from the 1 hour time frame. I need you to pay very close attention to everything. So for Monday's trading, this was the previous week's high here. So we have the previous week high, which is here, which is this. Now we have buy side liquidity resting above it. Now you already have a clear draw on liquidity, previous week high. Now let's mark out the days trading. This is the midnight and this is the close. So when, let's say you're trading the New York session, everything we'll be doing in this group will be primarily focused on the New York session. So during the New York session, sorry, after the midnight opening price, during London's trading, price made these highs, these relative equal highs here, which is buy side liquidity, which we had buy stops resting above it. This is the second indication giving us our John liquidity. So here you have buy side. And another thing, this video will be long. If you are looking for a 1 minute trainer, a 5 minutes trainer to understand market structure, you are definitely in the wrong place. You have to understand exactly why that market structure is the way it is. And to understand that, you have to understand the basic of liquidity and imbalances. Else, it will everything we're about to discuss in this model will fly over your head. So now you have buy side liquidity, which was created in London's trading. This buy side liquidity now is the previous session high. So let's label that previous session high. So there's previous, because we are trading the New York session, the previous session high is what we are targeting. That is our first partial, and this is our John liquidity, meaning we are expecting higher prices. So everything you do in the lower time frame, it will become subordinate to the higher time frame. That means the higher time frame will become, it should be like, okay, let's go. Going down into the 15-minute time frame, you have this. So we're going to label this the midnight opening price. So we'll call this midnight. Let's make this larger. And here you have the midnight opening price. So because we are bullish, we are expecting higher prices. When price purged out sell side liquidity, when price purged sell side liquidity, this is an indication of price wanting higher prices. So here we have sell side purged. And now you have this liquidity pool, this liquidity pool, and this liquidity pool, which is the previous weekly high trading. Now, for for a high probability trading, for a high probability setup, you want to have at least 2 points of partial, 2 points where you expect to take your partials out of the marketplace. When you have those two levels, those two liquidity points, or a pool or a point of imbalance where there's an imbalance price action as where you want to take something off, that's will indicate that's usually indicates a high probability setup. So let's go to 5 minutes. So on the 5 minutes time frame, this is what we have here in price. So we're going to label this with what they are in price action. So as you can see, this right here, this is a long-term low. So you call this, let's call this a long-term low. And here you have a long-term high. Now, when this long-term low and this long-term high has been established, this is now the daily range because we have taken out sell side and also taken out buy side liquidity. Now, this is now the daily range we are currently trading inside of. And so now, because we are bullish in price action, because we are expecting higher prices, any any drop in price action, anytime price reverses lower, using this body of price action as the basics of our understanding, when price drops lower, you expect that drop to go and fill in a pool of imbalance, an imbalance. And every time price goes down to balance an imbalance, to rebalance an imbalance, that is an intermediate term high or an intermediate term low. So you have this as your intermediate term low. Let's call this an intermediate term low. So you see, an intermediate term low, it is that low that has balanced an imbalance within your dealing range. And because you are bullish in price action, using this body of price action as the basis of this lecture, every time price balances that imbalance, you regard that as an intermediate term low. And when you are bullish in price action, you do not want this intermediate term low to be violated because it has already balanced this imbalance here, which is this. Let's mark out this imbalance here. Let's make this blue, reduce opacity. So every time price balances an imbalance, that is an intermediate term high or an intermediate term low. And because you are bullish in price action, you do not expect price to trade to this long-term low after balancing this imbalance. So when this imbalance has been balanced, you expect price now to rally higher. Does that make sense? So this now is the intermediate term low. Now price can trade back down inside this imbalance here, which coincides with this bullish order block. If you drop lower to a lower time frame, it will become clearer. But we are using the 5 minutes and 3 minutes to understand, to map out this market structure that we are currently talking about. So now this short-term low is your second opportunity in case you miss this rebalancing of this imbalance. If you miss this rebalancing of this imbalance, price generally gives a short-term low, a short-term trading price action. Either when you are bearish, it will give a short-term high for you to enter, or a short-term low for you to enter. So this low that trades back down inside of this imbalance and this bullish order block here, you have this bullish order block from the 10:25 a.m. candle. when price trades back down into it, you buy. You buy from here, expecting higher prices. Your stops below this intermediate term low, or if you are more conservative, below this long term low, because price can still trade back down inside of this imbalance. That will become a, a return to fair value. So price is allowed to return back down inside of the fair value gap, especially the weeks of it, because the body has already closed here, not filling inside this imbalance. So this is indicating bullishness in price. So you do not expect price to trade back down to this week, to this low of this week, which is the intermediate term low. An intermediate term low, it is every time that price balances an imbalance, every time that price rebalances an imbalance, that is an intermediate term low or an intermediate term high. In this case, an intermediate term low, because we're expecting bullish price action. And you do not just enter with just going into a body of price action looking for every time price balances an imbalance and stuff like that to then generate a bias or a narrative. You must first have a draw on liquidity. Every time you do not have a draw on liquidity when you are trying to trade, you stay away from the or from chart, because that is price indicating a low probability body of price action. So let's we'll label this the short term low. So the short term low, so the short term low is the last and final opportunity that's traced back within an order block or a an imbalance which was left doing when price was forming that intermediate term low. So when price goes to form an intermediate term low, it will generally leave an order block or a fair value gap, which can be traded back down into by the short term low. And this is price giving like an indication to people that are in the know, people smart money that miss the miss this pairing of liquidity here, which took place here when the sell side was purged. The smart money traders that miss this entry here, price gives another pull, another form of entry when it balances this imbalance here. Then again, price does this. Price creates a short-term low, which trades inside of this imbalance. Sorry, inside of this order block, this bullish order block here, and rallied higher. And you have to every of ICT's concept, you have to implement time while doing it, because this is a valid purge of liquidity, because it is inside of a Q zone, which is the New York Q zone. The equities market opens at 9:30 a.m. and that is for the morning session, opens at 9:30 a.m. and closes at 12 noon. So and 12 to 1 is lunch. During this lunch time frame, you do not want to be trading. But that's by the way. We'll discuss time frames and Q zones later on. Because this purge took place within a Q zone, this is now a purge of sell side liquidity. You see, this is not a purge of sell side because this is outside of the Q zone. 6:30, this is outside of the Q zone. London already took place. And here we have this price creating this low here, which will be needed. This is the algorithm engineering liquidity on both sides of the market, on the sell side and on the buy side of the market. Currently, looking at this price action, my mind is rolling back and forth, trying to explain the concept of power of three. This is the basic concept of power of three, but this is not what this video is about. This video is already complicated as it is. We'll talk about power of three on a later video. So this is on market structure. So remember, let's dive lower. Let's go to the 3 minute time frame. So as you can see, as indicated earlier, so this here to this low, this is the imbalance here. This imbalance was on the 5 minute time frame. This is it here on the 3 minute time frame. So when price rallied higher after creating this long-term low here, price rallied higher and created a long-term high and traded back down to leave this intermediate term low, and an intermediate term low is that low that balanced and imbalanced in price action. And now, like I said earlier, when price made an intermediate term low or an intermediate term high, price leaves an order block or an imbalance in price action. And this imbalance of price action or the order block, this is price giving those in the know the last opportunity to get into the market to follow the impending move of price. After making an intermediate term low, generally when price rallies higher, yeah, price gives a false bear flag. This is what you want to see before price trades back down inside your imbalance or your bullish order block for you to participate in the move. You want to see, every time you're in the marketplace, you want to see retail idea trying to oppose your own idea. Once you see that, a that is indicating a higher probability trade, because you are seeing the victims in price action. When you can see the victims physically in price action, that is better, because now price will form this candle here. Before this moves form here, this candle here will form a false bear flag. This false bear flag is what you want to fade by entering, by placing your entry on the high of this fair value gap here, which is this fair value gap here. That is the high of the fair value gap, and this is the low of the fair value gap. And because you are bullish, you do not want to see this, you do not want to see price spend a lot of time inside of this imbalance here, because price has already traded, price has already balanced an imbalance here. So price has no business staying too long inside here again. Does that make sense? So the short-term low or the short-term high is price giving the final, like it's like a train station in airports. When you go to the airport, when you're trying to board a plane, first they will make a first call that flights so and so boarding to this state. They will make a first call, then they'll make a second call to alert people that were not early, that didn't come early to the airport, or people that didn't hear when the first call was made. Then that second call will be made to reinform them. Then a final call, you hear final boarding for flight. Then the flight number will be called. That final boarding, that final call, this is what this short-term swing in price action is trying to indicate. It is this final call. It is the final call in price action, calling those in the know that are trying to participate within this morning session, within this New York session. This is the final call, calling them to participate in that move. If they miss this move, they cannot enter again, because when you want to enter from the morning time frame, it is better to enter before 11 a.m. Every time from my personal studies, every entry that forms after the 11 a.m. window, it is mostly of low probability windows. So the best form of entries form within the 9:30 a.m. window to the 11 a.m. window. So this short-term low, it is the final boarding, it is the final call for travelers trying to board the move to this London high. This high is the previous session high, which is London. Let's label this London. So this is London's high, and this is previous weekly high. So you have two pool of higher time frame liquidity, which is your target. So as you can see, so this is what we had yesterday for yesterday's trading. So this is for compliance reason. This is all demo. Do not take anything you see online as the truth without, unless you have practiced it, you've intensely gone into price action to test it by yourself to confirm that this is truth before you take it as truth. So this was the business for yesterday's trading. So when price rallied higher here after purging out sell side liquidity here, we're high London's session high and the previous weekly high. Here, when price balance this imbalance here, when price balance this imbalance inside of this intermediate term low, this was my entry. The entry was made here when price traded back inside of this intermediate term low. If I was pyramiding my position when price made the last call with this short term low, I would have entered here if I was pyramiding. But this was a one shot, one kill move, just to illustrate this today. So entered here when price balanced this imbalance here, which was created by this leg here. Enter from the intermediate term low, which is an imbalance. You enter from an imbalance or when price purges or sweeps a pool of liquidity, then you exit from a pool of liquidity, or when price balances an imbalance. Those are your two basic criteria on when to exit and when to exit. Write it on your journal. You enter when price purge out a pool of liquidity or balances an imbalance, or and likewise you exit when price purge out a pool of liquidity or sweeps a pool of liquidity or balances an imbalance. So this was the business for yesterday's trading.